Today, we're diving into Haigan Information Technology, a pivotal company in China's domestic computing sector. Its story is really a dual narrative, one of immense opportunity driven by national strategy and technological demand, set against a backdrop of significant risk and market pressure. And that really is the core thesis of our analysis today. Haigan finds itself at a unique crossroads. On one hand, it's propelled forward by the powerful tailwinds of technological localization and the explosive growth in AI. On the other, it faces profound geopolitical headwinds and a valuation that reflects incredibly high expectations. This tension is what we'll be unpacking. So, how has the market been reacting to this narrative? Well, let's look at the data. In a recent 6-week period, Haigan stock registered a gain of over 11%. You can see that this significantly outpaces both the Star 50 and the broader CSI 300 indices. This tells us the market is placing a specific, concentrated bet on Haigan's individual story. All right, so let's break down the first part of this equation. What exactly is fueling this performance? We'll examine the fundamental drivers that have positioned the company where it is today. From a historical perspective, the company's financial engine has been operating at a high velocity. Between 2022 and 2024, its revenue grew at a compound annual rate of nearly 34%. But the more telling metric is net profit, which expanded at an even faster 55% CAGR. This indicates improving profitability and operational leverage as the company scales. Now, the company's growth strategy is built on two key pillars. First, you have the CPU business. This is grounded in the x86 architecture, giving it a stable base in the government and enterprise sectors where domestic substitution is a priority. Then you have the DCU, or their AI accelerator business, which is designed to capture the explosive growth in AI computation with an architecture that aims for broad ecosystem compatibility. The most recent quarterly results for Q3 2025 reveal a very deliberate strategy. You see revenue growth of nearly 70% year over year, but net profit growth is a much more modest 13%. So what explains this divergence? Well, R&D expenses also surged by over 50%. This is a clear signal of the company's choice, forgoing short-term profit to accelerate long-term technological development. And here is a particularly powerful forward-looking indicator, 28 billion yuan. This figure represents the company's contract liabilities. In accounting terms, this is deferred revenue, essentially orders that have been paid for but not yet delivered. It represents a substantial order book providing a high degree of visibility into near-term revenue streams. Let's turn now to a major strategic development, the proposed merger with its parent company, Sugon. The objective here is to create what they're calling a computing carrier, a vertically integrated entity that spans from chip design all the way to complete server systems. This is a transformative move. So what's the strategic rationale for this complex subsidiary acquires parent deal? Well, it breaks down into 4 key areas. First, greater bargaining power with suppliers. Second, it secures a large internal source of demand via Sugon's server business. Third, it allows for tightly integrated R&D across the entire stack. And finally, it builds greater scale and resilience in what is an increasingly fractured global supply chain. And really, the underlying logic is clear. In today's geopolitical climate, this kind of vertical integration is viewed as more than just a move for business efficiency. It's increasingly seen as a strategic necessity to ensure supply chain security and operational resilience. Okay, so we've outlined the growth drivers, and they are indeed compelling, but that is only one side of the ledger. To have a complete picture, we must now examine the other side, the significant risks and counterweights to this growth narrative. A crucial piece of context here is the market's current valuation. As of October 2025, the company's forward price-to-earnings ratio was approximately 183. Now, this isn't a judgment on value, but it is an objective data point that shows the exceptionally high expectations for future growth that are already priced into the stock. When we categorize these risks, several key themes emerge. First, and perhaps most significant, is the geopolitical and supply chain risk, any potential for tighter restrictions on key technologies or licenses. Second is technical dependence, both on the licensed x86 architecture and the immense challenge of building a software ecosystem to rival established players. Then you have execution risk associated with the merger itself. And finally, from an operational standpoint, a high inventory level and significant customer concentration present their own set of potential challenges. So given these powerful opposing forces, how should we frame the path forward? Let's distill this entire analysis down to the central question and identify the key factors that will be critical to monitor. As we move forward, there are several signposts to watch. On the financial side, we'll be looking at the revenue mix, specifically the contribution from the DCU segment, and, of course, the trend in contract liabilities. From a corporate perspective, any news on the Suligan merger's progress is key. At the macro level, any shifts in technology policy remain a critical variable. And finally, the competitive landscape is something that requires continuous monitoring. And this brings us back to the fundamental question that defines the Heidegger narrative. Can the company's strategic push for integration, combined with its strong position in a large domestic market, generate enough momentum to overcome both the external geopolitical pressures and the immense expectations already embedded in its market price? This remains the central tension for any ongoing analysis.